You are listening to the Manument Podcast. My name is Casey, and I'm here with my buddy Glenn Johnson, investment advisor and founder of Jabez Financial right here in the Uncasville area. Glenn, we're starting to hear now more about 401k plans potentially adding things like Bitcoin, private equity, even access to IPOs. Regulators and plan providers are actively exploring these options, but they do come with higher risks, they come with higher fees, and less transparency than what most people are used to in a 401k. So I'm curious your thoughts on this and what you think for somebody, let's say in their 60s, who's nearing retirement, or maybe they're already in retirement. How should they be thinking about these newer investment choices? What are your thoughts on this?
Yeah, well, let's look at this. Let's look at why 401ks came into creation in the first place.
Okay.
They were there to replace pensions. And because companies were being bought and sold not because of their income statement and balance sheet, but because their assets were so large in their pension funds, they were worth more than the companies. Mm-hmm. And the government didn't like that. So they stepped in, wrote tax code section 401k, 403b, and so on and so forth. But the intention, like back in the day, the objective was to get a good education, get a good job with a good company, with benefits and a pension, right? And with the birth of 401ks, they're really there, just like the pensions. They're designed to attract new employees, younger employees, with long-term investment horizons. And now the 401ks, they do include some less risky fund allocation models, right? So let's say within a 401k, you've got 30 different investment options. 10 of them are going to be more aggressive, 10 of them are going to be moderate, and now you're left with 10 conservative ones, relatively. But you're still in the same stock bond investment arena. But knowing full well that the most suitable investment options for someone nearing retirement are most often found outside of 401k plans, there's almost always an option to do what's called an in-service rollover once you've reached age 59 and a half. So I guess the point is the 401ks, they're designed for younger people with a long-term time horizon, but they know full well that these 401ks become less and less suitable for people nearing retirement because the investment options for more stable investments, they're just not in there as much. So they allow people to take it out. But with pensions don't offer that option. All of your pension money has to stay there till the day you retire. But then again, those pension funds are professionally managed and structured to provide a long-term, more secure income. So therefore, the pension funds, they don't really have to give you an option to roll the funds out early because they're better managed.
Okay, so that really sets the stage for us when it comes to 401ks, because these plans, they're built for accumulation over decades throughout your working years, not necessarily to accumulate income once you're super close to retirement.
Right. And so now looking at the fact that the 401k plans are now introducing investment options like Bitcoin and private equity and even IPOs. Wow. This can't end well in the long run for people that are nearing retirement because, it's exciting at first because all of the growth potential that comes from riskier investments, but most of the growth, if not all of it, is in capital appreciation only, no income. Like Bitcoin doesn't earn anything. Its growth is 100% capital appreciation. And that's the growth that comes with the excitement of investing in an IPO. Almost all of it is capital appreciation. Those IPOs, they haven't earned much of anything yet. They haven't proven themselves. It's just excitement over potential gains.
Well, and I think that's a key distinction that people miss because we know that the growth feels exciting, but it does not automatically translate into income that you can actually live on and use in your retirement.
Right. And I think in part, people are drawn to those types of investments because they have the appeal of capital appreciation, which is exactly what we've seen in most of the stock market since 2009. And people have forgotten about those long-term secular bear markets. See, when we talk about the market being overpriced, what that means is that the earnings, the companies are earning, their earnings are very low when compared to how much the stocks cost. That's that whole price per earnings ratio. And adding more investment options into 401k plans that primarily look at capital appreciation while ignoring the need for stable income, it significantly increases the risk.
So, all right, when we look at all of that together, higher risk, higher fees, no real income component, that's really where the danger shows up for somebody who is relying on this money, relying on these dollars to pay their bills in retirement, right?
Exactly, which is exactly why the precedent is that once you reach age 59 and a half, you can roll it out and get into something far more suitable, which is another reason why it's good for me to get together with my clients before they retire. Mm-hmm. When you're knocking on the door of 60, it's really important that we start having that conversation now so we can get you better positioned. But regarding the funds that you have earmarked to provide your retirement income, they just shouldn't be exposed to that kind of risk in the first place. It's a bad idea to gamble your source of future income, because there are far more suitable investment alternatives for retirement that can still outpace inflation without the risks that come along with the typical investments that you find inside 401k plans.
So for that listener that's in their 60s that you just mentioned, Glenn, and let's say they're hearing about these options and they're thinking, is this for me? Is this something that I'm missing out on? Your answer is really about matching the investments to the phase of life, right?
Exactly. And that's where if you look at the investment options inside 401ks, they started with putting together portfolio funds. And you'll find them in there. They'll say like a 2030 fund or a 2035 or a 2045 fund. Mm-hmm. It's what they are is a fund of funds. It's one mutual fund and it's a portfolio. And they're really just looking at your target date of retirement, and they'll slowly dial back your risk exposure. However, that's why when you look at this investment options, people say, oh, geez, I've only got 30 options inside my 401k. Well, really, in your season of life, you only have maybe 10 options that fall into the realm of relatively conservative allocation models. So there's fewer options that are suitable to begin with. And there's always something better that's available, and it's worth exploring and finding out what those options are so that you're in a better position with more appropriate, more suitable investments.
When we're treating our retirement money like it's still long-term growth money, can you talk a little bit more about what the exact danger in that is?
Well, with a longer-term time horizon, it's okay to assume more risk. And that's why most of those investment allocations inside 401ks, they're designed for a long-term time horizon. So inherently, they have more risk built into them. And this is where we need to dial that back the closer you get to retirement. Or if you're already retired and you find yourself and you're knocking on the door of having to take out required minimum distributions, there needs to be a place you can go so that you can take this money out without your account taking a dip right beforehand.
All right. So let's say somebody is interested in these new options. What kind of questions do we need to be asking ourselves before we're saying yes to these options? Is there a checklist that we can go down and kind of, fact check ourselves?
After we have a conversation about where the economy is, where the market is, we kind of have to sit back and ask ourselves, now, imagine if you had all of your retirement money sitting in a pile of cash on your kitchen table. There it is. Given where the market is, with the bubble that we're in, how much of that money, if you had all of your money in a pile of cash on the kitchen table, how much of that money would you want to put into the stock market right now with the belief that things are going to keep climbing higher and higher and higher? Mm-hmm. Well, that's how much you should keep there. And a lot of times people find themselves like, oh, geez, I wouldn't want any of it in there. Or maybe I just want a small portion of it in there. Well, that's how much should stay there. That's how much you should keep. I mean, if you wouldn't buy it, why would you keep it? But people still have it because they've had these investments for so long. It's just a part of life. and they've seen the ups and downs. That said, they've seen more ups than downs, so it makes it easier to stay there. But there reaches a point when something just doesn't feel right. We've got to ask ourselves, is my guts telling me that I should do something about this? It's almost like when, living here near the casinos, I've heard people tell me, yeah, I was at the table and I had that little voice in my head said I should walk away, but I didn't, right?
Hindsight's 20/20, Glenn.
That's right. And so, you know what? If you've got that voice in your head saying, I should, maybe it is time for me to start dialing this back, there's the check engine light. There's the warning. So it's almost like your gut has already told you that you've got to do something about it. But when you give us a call and come in for a conversation, you can rest assured that that's all we're going to do is have a conversation about it, so that when it comes time for you to make a decision as to what you should do with your life savings that you've put all your time and effort into accumulating, that when you go to make that decision, you're making it based on facts, based on being smart about it, making wise financial decisions rather than just letting things fall where they may.
Thank you so much for listening to this episode of the Manument Podcast. Make sure you subscribe wherever you get your favorite podcasts so that you never miss an episode, and we will see you next time. Take care.
Investment advisory services offered through Jabez Financial, LLC, a registered investment advisor firm. Registration is not an endorsement by securities regulators. By contacting us, you may be provided with information about insurance products, including annuities offered through Glenn Johnson, Connecticut Insurance, license number 4628409. The firms are separate entities. Annuity guarantees rely on the financial strength and claims-paying ability of the issuing insurance company and are not offered by Jabez Financial, LLC. Read your contract for restrictions, limitations, or penalties. Jabez Financial, LLC is not licensed in all 50 states. To find out if Jabez Financial, LLC is licensed in your state, please call 860-390-0093.